how's the economy doing? That depends on your perspective. So writes Gillian Tett of the Financial Times just this week. And Jeff, we're going to talk about Jeff Snider, the head of global research of Alhambra Partners. Jeff, I'm going to read this out to you because she writes that she explains why we need a new view to supplement more traditional models. So I'd just be interested in your perspective on some of these items that she raises here. Okay, so the current state of the US economy is sparking much head scratching. Some data seems to be cheering. Great. Spending on durable goods, for example, rose 1.3% in October, twice the expected level. And of course, Jeff, you jump in whenever you want to. And Deloitte projects that total consumption and expenditure will have risen by a whopping 8.1% in 2021 after shrinking in 2020. That is partly a catch-up effect after the pandemic lockdowns, but consumers have benefited from stimulus checks, a booming stock market, and an apparent abundance of jobs. Indeed, there are currently 1.4 vacancies per unemployed person in America, a historic high, and a record 4.4 million Americans voluntarily left their jobs in September. We just talked about this in part 2. It sounds great.
Yep, job openings, record high, labor shortage, all that stuff. I don't know why she threw in the stock market, but why not? I mean, people talk about it as if it's that the stock market actually discounts reality when we know that it doesn't. So sure, record high stock prices, wealth effect, all of the theoretical economic models seem to say job openings are right. The economy is not just robust, it's incredibly robust.
Almost too robust. It's a daring gamble. Yeah. Extraordinary.
Too much. We've gone too far. Yes. It's inflationary now.
Okay, so here we go, part 2. But on the other hand, yet other data are far less festive. If jobs seem plentiful, wage growth is still relatively subdued by historical standards. And though American shoppers are spending, their mood seems peculiarly glum. In November, the Michigan Consumer Sentiment Index, a monthly survey that gathers information on consumer expectations regarding the overall U.S. economy, was running at 67.4, a 10-year low. And
yes, lower than 2020. That's so, but I mean, let's stop here for a second because yes, consumers, as she pointed out, they've been buying goods at a historic rate. There's no question that consumers have been shopping on Amazon, whether there was the pandemic or now just because they're spending money that Uncle Sam gave them. Whatever is the case, they are buying goods at an incredible rate. However, they are not consuming or purchasing services at even the level that they had before the pandemic. So overall, consumer spending is not in any way, shape, or form like it is from specifically durable goods or even just the goods economy overall. That consumer spending, including services, is actually well behind where it, quote unquote, should be if we hadn't run into the COVID virus and the unnecessary reaction to it and the recession in 2020 and the lack of recovery since then. So on the one hand, the goods economy looks like it's robust, inflationary, all that. But on the other hand, when you look at the wider context of the US economy, you start to think, yeah, well, we bought goods because we're not buying services. So we're not actually adding more or doing more. We're just doing more of one thing and less of another. And that creates all sorts of incredible problems too.
Logistical, shipping, transportation.
I mean, where does these supply shocks and everything coming from? We basically rewrote consumer behavior in the space of 18 months. So that's going to be an issue.
So consumption of goods, it is not only back where it had left off, right, before the coronavirus, it's now above the trend, the medium to long-term trend, right? But if we look at it at services, you said it's not back to where it should be, meaning have we recovered back to whatever the 2020 high is, but we're still way off? Okay, so we're not even back to that.
We haven't even recovered to 2019, the fourth quarter of 2019 levels, let alone where the trend had been before the interruption in 2020. So we're not even back to even yet. And here we are almost 2 years later. So that's good service, spending on goods way up, spending on services way down, balancing it out, we're behind.
She continues to just inform us regarding the consumer survey, the Michigan one, that it's, as you said, 12.4 percentage points gloomier than in November 20, near the height of the pandemic. Jeff, I recently saw, and I sent you this study where they used the Michigan Consumer Survey and the Conference Board Consumer Survey as a predictor of recessions, where we know that the US bond market is really, really good at predicting these recessions whenever it inverts. Well, this recent study found that yes, if you look at it this way and if you squint your eyes, yes, US consumer sentiment with these two surveys is a predictor of recessions. And they're saying, hey, right now, we're at that level. We are at that level predicting a recession. Jeff, you jump in and tell
Not
the
only
audience
that,
that.
as we talked, Emil, as we talked about in the last segment, it's really consumer confidence in the University of Michigan survey, as well as to a lesser extent in the Conference Board survey. Where did those peak and where did they start to reverse? June. It's consistent timing across the board. So we've seen labor market cool down in some of the indications, including the headline establishment survey. We've seen consumer confidence sink over the last 5 or 6 months, the second half of 2021. And it's not just in terms of at least the University of Michigan's numbers. It's not just that consumers have gotten a little bit gloomy. The consumer confidence has simply collapsed. And again, as you pointed out, it's worse than it was not just in November 2020. It's worse than it was at the bottom of the recession in March and April of 2020. So something is not right here. Consumers are glum. Yet all we hear about in the media is how the economy is awesome. Everything's good. Jobs are plentiful. In fact, jobs are overabundant and employers can't hire. But yeah, as you also pointed out, wage growth is nothing really is it really that good? Are we really seeing wages rise? Certainly not rise at the rate we would expect if there actually was a labor shortage. Because as we always say on the show, there is no such thing as a labor shortage. There is only businesses who are, for some reason, refusing to pay the market clearing wage. Because if businesses paid what labor wanted, there would be no labor shortage. So if businesses aren't paying the rate that labor wants, then it must be something else. And usually over the last 15 years in particular, that has meant the economy isn't as good as everybody says it is. And the businesses can't pay the market clearing rate for wages because of macroeconomic reasons. So we're starting to get the feeling again here, just from this article and the way it's being set up, that it's very much like 2018 or 2014. The economy seems like it's doing well according to these certain statistics, but everything else kind of makes it sound like those statistics are looking at something else differently, or maybe they're just not appropriate for these times.
That idea of a labor shortage not really being out there if the market clearing wage was paid is starting to filter out into the wider audience, Jeff. This is totally anecdotal. I never heard anyone else say what you said for years, that there is no labor shortage, that if you paid a market clearing wage, everyone would be perfectly happy and satisfied and hired. Recently on Twitter, I have been seeing people that are completely unrelated to you, academics, saying, no, there's no labor shortage. You just don't want to pay more. And of course, we can go from there as to whether or not that's because businessmen and women are greedy and terrible and awful, or because they don't see a profit in the future and they can't take that risk on, which we've talked
about.
That's
it, right? Absolutely. Yeah. It's a projection of the future. It's because in an actually booming economy, what would happen is businesses would say, business is so good now and it's going to be so good in the future. I don't care what I have to pay for labor. I got to get people in here because things are really booming. And maybe if things are booming right now, but if you're not confident that boom is going to last, you're still going to be reluctant and hesitant to bring people on, because once you bring people on, it gets to be sticky, it gets to be a problem. You can't just let them go. Maybe you have to raise wages, and then you have to raise wages across the board. It becomes an issue where bringing people on, you got to be relatively sure, not just about today, but also next year and the year after. You got to think that the economy is legitimately booming before I really pay what the market seems to want for work. And if you're reluctant to do so, it's not because there's a labor shortage. It's because there's an economy shortage.
Yeah, good. Well, that message is filtering out there, Jeff. I'm seeing it more and more. Back to Miss Tett. I suspect there is a psychological issue too. One reason inflation sparks such gloom is that price hikes have been so unknown in recent decades that a generation of consumers does not know how to parse the current outlook.
No, I'm sorry. We've seen this before, and we're not children. Anytime a writer feels the need to treat their audience like children, we're not used to inflation, therefore people don't know how to handle it, so they're extra gloomy. No, we saw this, 2011. We saw it to some extent in 2018, just 3 years ago, when oil prices and gasoline prices were almost as high as they are now, and you didn't see this kind of hand wringing and pearl clutching back then because there was no reason for it. So if she's trying to say that, the reason people are gloomy is because they don't know how to handle consumer price increases, no, I'm sorry, I don't buy that one at all, especially since consumer price increases have happened. They just haven't stuck around. That's why we've had this disinflationary environment. It's not that the consumer prices have been flat continuously for a dozen years. They've been overall not rising in a consistent rate. They've been more lumpy and grouped together, like 2008 or 2011, or to a smaller extent in 2018. It's that the fact that the consumer prices accelerate and then they fall back, which is kind of what we're looking at here. So maybe consumers are glum because, unlike some people, economists in particular, and people in the media, they realize what's coming next might not be 1975.
The downbeat mood reflects disorientation as much as tangible pain. Moving on. So even if they are happy to spend money right now or to walk away from the jobs they dislike, they feel scared about an uncertain future. This possible psychological explanation is, however, just a hunch. We do not have much data on how consumer time horizons may have shifted in a wider sense. And this brings us to another important point. Economists and policymakers need to upgrade their systems for tracking the economy right now to blend quantitative and qualitative perspectives.
Yeah, I think that's a huge problem, and she's missing the point here because I think she's got it, which is that consumers, unlike economists and media personalities, understand the last 15 years, that every time they're told to expect inflation and economic acceleration, we end up with a false dawn. So, it's once bitten, twice shy for consumers where it isn't for everybody else. So consumers might be glum because they realize on a very personal, intuitive level, we've seen this before. Every time you say the economy is about to take off, it never does. And so we grow pessimistic because you said it was going to take off in 2021, but this year hasn't really worked out the way everybody said it was going to. We're starting to grow pessimistic, not because of inflation, but because we've seen how this movie ends. We know what's coming. It's not an acceleration. It's not inflation. We go back into a moribund, disinflationary or deflationary economy around parts of the world. So maybe consumers are actually smarter and more attuned than we give them credit for. And that the reason they're becoming glum is because they know what's coming. They know what's happening. Like the bond market, they can see, yes, stock prices are through the roof and consumer prices have accelerated, but that doesn't mean what comes next is inflation or growth. It likely means the opposite. Consumers might actually, like workers, we've talked about this before, right? Workers that are not flooding back into the labor markets. They're staying outside of the labor force because they know on a very personal, intuitive level, the labor market is not robust. It's not worth their time even looking for a job because they know there's no jobs available at wages they want or need to be paid. So workers are not going back into the labor market, which tells us something about the labor market. Consumers are glum. Maybe they're spending on goods, but they're not spending on services. So maybe they're telling us as well something about also the labor market, as well as the macro case in general. And she's right. Economists and policymakers need to get with it because they've been ignoring these signals, not just ignoring them, arrogantly dismissing these signals for far too long because they're in some ivory tower with some highly credentialed, well-paid job, and you're just some stupid consumer who doesn't even know how to react to a small increase in the consumer prices.
Well, Jeff, you've solved the riddle that she's going to pose. What you just said, it was all right there. We could stop the show. I'll continue. But yes, essentially, listen to consumers, listen to the bond market. You mentioned the bond market.
It's listen to consumers when it's inconvenient to you. So that's really the problem is, they'll listen to consumers as long as consumers express their fear of inflation, right? If consumers were saying we're afraid of inflation breaking out, then policymakers, yes, we need to listen to consumers. But as soon as consumers would grow pessimistic about macro factors and think, oh, the economy is not going to be very good at all, setting aside consumer prices, inflation, if consumers express doubts about monetary policy working, what are monetary policy makers going to do? They're going to immediately say, oh, you're a bunch of stupid ass consumers. We don't need to listen to you. That's what needs to happen. You need to listen to all of these data points when they're inconvenient, when they're most inconvenient to your narrative and your assumptions.
Economists and policymakers need to upgrade their systems for tracking the economy right now. Typically, economists try to project the future by collecting reams of data on the recent past, looking for correlations and then extrapolating forward. However, if consumer behavior is in flux, the past must not be a good guide for the future. At such moments, we need a worm's eye view to supplement any bird's eye model.
Let's stop right here, because that's not the problem, and that's not what economists do. As we both well know this, Emil, economists don't look at the past and extrapolate the future. They look at the past and say, what can we do to change it so that the future becomes what we want it to become? And I'm thinking specifically about monetary policy stimulus. So what happens is monetary policymakers in particular look at the past and say, this is not good. We're going to do QE. We assume QE works because we believe in this stuff, sort of like, some kind of voodoo or astrology. So our econometric models look at the past and they don't extrapolate into the future from the past. They extrapolate in the future from the QE. And so they say, we did a QE, it's going to work because we believe it's going to work, and then it doesn't work. And consumers have told us the whole time it wasn't working, but we ignored those consumers. We ignored the labor market, except for the unemployment rate, which is poisoned and spoiled by the lack of participation. But we've set that aside too. We've said Americans are lazy, they're drug addicted and won't go back to school. We've come up with all sorts of reasons to dismiss these signals because we've extrapolated not from the past, but from the QE. So econometric models immediately believe that QE works. Therefore, the future should look very good. And when it never does look good, never does become good, they're all confused about why that is, even though they've dismissed all of these very good signals that have told them your assumptions about QE and just stimulus in general are all wrong. And this includes fiscal stimulus. Same thing. Economists extrapolate from a fiscal stimulus and say, oh, yes, the past was bad, but we did fiscal stimulus, so the future will be good. And as the future develops, consumers don't respond to it. The labor market doesn't respond to it. And economists still dismiss those signals anyway because they're extrapolating from their assumptions that stimulus will actually stimulate. What really needs to happen going forward is policy makers need to go back to the drawing board, go back to square one, and challenge their assumptions on this quote unquote stimulus nonsense from the very start. And then doing that, they'll be able to then correspond and correlate all the data and signals that we get in real time from the bond market, from the labor market, from consumers, which will tell them you guys were wrong about stimulus all the time.
I love the passion, Jeff. Take 5 minutes, get a drink of water, walk around. The audience will wait. We'll just go dead air for
Emil,
5.
It gets me really riled up. Number one, I get really frustrated because this has been going on for how many years now? And we really shouldn't be having this discussion. If economics was anything like a scientific endeavor, this would have been solved a long time ago. Because science is you make observations, you make predictions, you make theories, and then you observe whether or not those theories are valid. And if they're not valid, you don't make excuses for them. And that's what really, pardon my language, pisses me off, is that economists have been not just making excuses for QE's failures, they're blaming you and me and Americans and workers around the world for their failures. They're saying that Americans are lazy and won't go back to work because QE didn't seem to produce the results that were predicted. Bull! That's not what happened. QE didn't work, and Americans have been suffering the consequences, not just Americans, but workers all over the world. As John Maynard Keynes had said over a century ago, deflation impacts the workforce first and foremost. Not only have Americans and workers in general suffered the consequences of monetary policymakers who don't know money, don't know their jobs, we're still pouring salt into the wound. Economists then and central bankers had then been blaming these very Americans and these very workers around the world who've been suffering for their incompetence for why they are incompetent. It's beyond frustrating. It's maddening.
Some institutions are trying to do this to come up with a new model. The Bank of England, for example, is using ethnographers to get on-the-ground evidence about economic conditions. Separately, some economists are widening the data sources they use. Albert Cavallo, a Harvard economics professor, has
There's your
recently
problem.
has recently used online real-time price data to track inflation in a manner that is far more timely and accurate than official consumer price indices. But far more could and should be done. The more that different data signals seem to send conflicting messages, the more important it becomes to combine those bird's eyes and worm's eye views. Rarely has the state of the economy been so fascinating, but so hard to read. The end.
No, see, it's only hard to read if you're steeped in the central bank culture. If you start from the premise that central banks are central banks and they're all powerful, then all of a sudden all this stuff becomes hard to read because you expected central banks to be very efficient and to be very successful. And it's very clear that they haven't been. And so even the fact that this article has been written, even the subject of the article where central bankers are questioning their own assumption is in one sense a good sign because they realize, hey, maybe we did screw up here. Maybe we didn't deliver on all the promises that we made. And that's a good thing. But yet they still can't break free from these assumptions that these are central banks, that monetary policy does work or fiscal policy does stimulate when maybe those things don't happen at all. And maybe we should listen rather than tell everyone what to think. We should listen to what everybody else is saying, what people on the ground have been saying all along about the way things actually are. And the way things actually are nowhere near the way they should be if all of these basic assumptions about QE and fiscal stimulus were anywhere close to accurate. So in a scientific endeavor, we shouldn't even be having this conversation because all of these things have been disproven so thoroughly. I mean, QE is the most empirically established and tested policy program maybe in history, going back 20 years to Japan. And yet to this day, people still call it money printing. The media articles still say it pours trillions of dollars into every economy when none of those things are true. So we have a good while to go before we actually get to realizing just why all of these things have failed. And it isn't going to help us at all if we let central bankers dictate the pace of change as well as the direction of change. Oh, we need to measure inflation a little more accurately. No, you need to go back to the drawing board of your Harvard Ivy League mathematics statistical education, not economic education, and start challenging your basic assumptions about what it is you actually know and think. Then we'll start to get to make some progress. This is not about fine tuning anymore. This is about starting from scratch.
My complaint is I'm all for the development of new models. Fantastic. I've heard of some fantastic work with satellites and counting cars at parking lots. Great. But my complaint is you don't need the new models. The consumer behavior surveys have been predictive of recessions in the US. The bond market has been predictive of recessions in the US. So you've got the methodology. I'm just restating what you said.
You just need to listen to it, right? Yeah. I mean, that's exactly, we've got the data in front of us. You just have ignored it all this time. You've dismissed it. You've created excuses for why the bond market's rigged. We can't listen to the yield curve because the Fed's, all this crap. You're exactly right. We have the data. What we lack is the ability or even the emotional maturity to accept the conclusions that have been in front of us the whole time.
Jeff, I don't want to bring up another sour note, but last we talked, the Bills of Buffalo hosted the Patriots of Boston.
All right, we're going to end the show here.
It was a wonderful, wonderful game. I love that windstorm. And the good news is there's a rematch, so the Bills will have a chance to get revenge.
I'm going to ignore the last 30 seconds and everything that you just said and pretend that none of that happened. I'm going to be like an economist and stick to my old model in which the Bills were actually a good football team.
Editor, please cut out the last 55 seconds. I'll talk to you next week, Jeff.
All right, take care, Emil.